Let's talk with Diane King-Hall, joining us from New York about some more earnings. Let's maybe flip it to the positive side real quick. Diane, Zoom video, since we're in the category of cloud.
Yeah.
You know, these reports from Zoom keep getting less and less awful.
It's true, especially when you think about where Zoom was and how it had been discounted in terms of the road it's come from its pandemic highs. So Zoom is certainly getting some love today off the back of its latest quarterly numbers. We've got a couple of the pandemic darlings in focus today, Zoom and Peloton, but as you mentioned, let's start out with Zoom. So adjusted EPS came in at $1.39 a share. That was better than expected. The expectation was $1.21. Revenue was $1.16 billion. That was also better than expected. It gained some strength in its large accounts, and it also highlighted that it had, quote, resilience in its online business. This according to the CEO. Guidance was better than expected, so the road ahead looks good for Zoom. Fiscal third quarter revenue is expected to come in a range of between 1.16 and 1.165 billion. Revenue expectations in line with expectations. EPS, though, better than expected. Adjusted EPS, Zoom is predicting between $1.29 and $1.31 a share. So it shows that Zoom is holding up in the face of a competitive landscape for the company.
All right. Yeah, a lot of competition. You know, we've known that. So maybe the market's got its head around it at this point, and stabilizing with some decent, outlook, I guess, and some pretty sticky customers. I think maybe the washout of all the fickle Zoom customers has perhaps reached a denouement, and now they've kind of got a reliable, maybe cohort of clients, which is good. But what about Peloton? Like, that to me is a little bit, more of a difficult comeback story to swallow. So they showed like one period of sales growth and we're up 18%. I mean, not saying much. It's a $4 stock.
I know. I mean, think about where Peloton was once upon a time. So it is, I mean, it's been working on this turnaround plan for some time now. We know that CEO Barry McCarthy, left the post earlier this year. So now it's being run by a couple of board members. Adjusted EPS came in at minus 0.08 a share. The expectation was for a loss of 18 cents a share. Revenue also was a beat at $643.6 million. So there was growth, and this is the first time you're seeing growth at Peloton since, we got the results at the beginning of 2022, but that was really about the holiday 2021 period. So it really hasn't seen the growth that it had, that runaway highway growth that it had during the height of the pandemic. But again, this was a quarter that was much better than expected. So it's certainly approved, and it's working on this turnaround strategy that it's been working on for some time now. It saw growth in the Bike Plus. Some of that was helped by the secondary market. So it's interesting to see that, you and I have probably seen this where you see the bikes going on sale online, but then people will have to sign up for a subscription. So it looks like that secondary market helped prop up subscriptions. Peloton says it's also working to kind of push its tread business. So we'll see where that goes in the road ahead. But so one quarter doesn't necessarily make a trend, but it's a step in the right direction for Peloton.
Okay. That's, I guess, the least we can ask for from Peloton at this point. But all right, maybe, there too. Maybe the kind of selling of Pelotons on the secondary market and the, kind of big drop off in activity and demand. Maybe that's kind of, I don't know, reached the bottom too, perhaps. So, interesting.
Yeah.
How about, let's go to the retail side. Williams-Sonoma down, Advanced Auto down a lot. I think Advanced Auto is a little easier to knock out real quick because that's been lagging its peers for some time now.
It has. Advanced Auto is under pressure off the back of its latest quarterly numbers, even, with what would normally be seen as a plus with the sale of one of its business. So in terms of Advanced Auto, adjusted EPS came in at 75 cents a share. That was a big miss. The expectation was 97 cents a share. Revenue came in at $2.68 billion. That was light as well. They also cut their sales and profit forecast. Its net sales forecast for the year is expected to be between $11.15 billion and $11.25 billion. Their prior expectations were between 11.3 and 11.4 billion, so that is down. It's faced a lot of activism around it, shareholder activism around it. They have said that they'll sell its Worldpac unit. They're selling that to Carlyle Group, the private equity firm. They're selling that for 1.5 billion in cash. That's part of its efforts to kind of, just streamline its business, but it's not helping the shares right now, especially when you consider the miss across the board, whether we're talking about the quarter gone and the road ahead for Advanced Auto Parts. Not looking good when you look at the shares under heavy pressure right now, down double digits.
Okay. Yeah. Return back to lows. And this kind of seems like a little bit of a cutthroat industry that has been maybe kind of underappreciated in its savagery. I mean, look at O'Reilly, look at AutoZone. These are like some of the most reliable stocks around. Advanced Auto just continues to decline both relative to its peers and just on its own. So I wonder what happens here. I wonder if there's going to be some kind of major shakeup, maybe a privatization, maybe I don't think there's going to be like a deal. It seems like there's plenty of destruction already happening. Like what would O'Reilly or AutoZone even want from Advanced Auto? I feel like, it's just sort of falling behind in a category that's seen some degree of slowing after a lot of car repairs. But AutoZone and O'Reilly have like the returning customer, and I think a little bit more online presence too, even though there's not a ton in this sector. Last one, Williams-Sonoma. This has been a standout as far as like high-end retail goes. So what happened? It had been.
So I was a little surprised to see this because, as you mentioned earlier, when you were kind of getting into this segment or ahead of this segment, how Williams-Sonoma had been holding up. But right now it is certainly facing some headwinds off the back of its latest quarterly numbers. Revenue came in at 1.79 billion. That was a miss. That was weaker than expected. Adjusted EPS beat, but it's really more about what both the revenue picture looks like and same-store sales, because comps came in weaker than expected as well for Williams-Sonoma. Same-store sales fell 3.3% on a year-over-year basis. That was also weaker than expected. And so that is leaving, Wall Street kind of wanting more in terms of Williams-Sonoma. And when you think about, what the demand picture looks like for Williams-Sonoma, it has been declining over the last several quarters. So, they've been trying to kind of deal with that by reducing some of their store count, but it didn't help, at least in the most recent quarter, when you look at what same-store sales were. So there's some weakness there. We've talked about that, their consumer has been kind of buffered when you think about where consumers are cutting costs, but it looks like they're certainly facing some pressure right now, or most recently.
Kind of feels like this was overdue to some extent. All the writing's been on the wall. Restoration Hardware, RH, high ticket items at Home Depot and Lowe's and even Target. They're gonna have to discount even more maybe at this point if they had to cut the guidance. We'll see if they do that, and if they do, I'll be there. I'm in the market for a new lamp, but I'm not gonna pay $400 for it.
Don't do it.
All right, thanks, Diane. Appreciate it very much.